We've had a lot of marketing from the RBI itself. The board meeting got scheduled today, though our seminar was scheduled more than 2 months in advance. Well, the slow path to reform in public sector banks. It's a topic that we have been concerned, we've been talking. You've seen a lot of press on this. But there is one person who has been working both as a researcher and as a practitioner in terms of being member of the NAYAK committee and working on some of these issues for the last several years now. So I'm very pleased to invite my friend and colleague from Indian School of Business, Krishnamurthy Subramanian, Professor of Finance. Sugu is also a senior visiting fellow at Brookings, India. We're very happy to have you, Sugu. Come here and address the crowd. The format will be after he has presented, we will have Professor Ila Patnaik from NIPFP, also a scholar well recognized in the Delhi circuit. Ila has been working on many of these issues pertaining to the governance of banks and RBI in particular. We'd be very happy to hear Ila's comment on Sugu's paper. That'll be about 10 minutes later, and then we'll have half an hour for Q&A at the end. So Sugu, you have an hour to yourself. Come, take it away.
Thanks. Thanks a lot, Shamika, and it's my first time here, but I'm really happy to be firstly among friends and among a very august audience. So I will have to apologize a little bit to Ila, actually, that I am drawing on some of the ideas that are not just in this paper, but work that we've done. So I'd be very glad to anyway, look forward to your comments. Just as a preamble, what I'm going to say is I'm going to try and focus a lot more on some of the changes that that at least I think are important. I think a lot of the analysis of the situation, what are the problems, many of us know. So I'll try and briefly talk about that, but focus a lot more on the solutions and see what we can do about it. So this is this is a paper that is written jointly with Dr. P. Naik, who, as you all know, was the chair of the committee that did some of the initial work on this in this area. So, where do I point this to? So I think true to character. Yeah. Okay. Great. So let me just start off by talking about the fact that in one of the first chapters in the NAYAK committee report, we had actually done an estimation of the amount of capital that will be required by the public sector banks, and this was as of 2014. And where we had done 3 different scenarios. One, what we thought was at the very least, sort of the most conservative estimate, conservative in terms of the amount of capital required, but and then what we've said that we found that at that time, by 2019, by which time all the banks have to comply with the Basel requirements, at least 2.2 trillion, or in other words, 2.2 lakh crores of capital would be required by the public sector banks. And this is the reason I bring this up is because at that time there were a lot of pushback on this, that this is sort of alarmist, because the other 2 scenarios that we had talked about, which were actually less conservative in terms of the capital, more aggressive in terms of recognition of the of the stress in the banking system, was the capital requirements were far more than this, and we got pushback on this. But just to sort of validate, the government's infused capital last year was 2.25 trillion. So I think there's but what is more important, I think, it's not the capital requirement that we focused on as much, but what we talked about was the fact that, in order to ensure that good money is not put after bad, the need for governance changes, which was the key emphasis on the report. And I've just sort of highlighted in red here, the onus of remedying the situation through radical reform lies primarily with the central government. In the absence of such reform, or reform is piecemeal or non-substantive, which is what I think has happened so far. it is unlikely that there will be material improvement in the governance of these banks. And I think that is also to a large extent true. So the fiscal cost of inadequate reform will be steep, which I think is what we are seeing right now. And I think let me mention that sometimes people ask saying, oh, why are you focusing on governance? Up until 2008, 2009, the same banks were doing so well. Public sector banks were doing so well. I think the important thing to recognize across any crisis, whether you take the Asian financial crisis or the Japanese crisis, Japanese banking sector, or the global financial crisis as well, governance problems come to the fore when things start going south. And I think the same has been true even in the case of public sector banks. So it's not enough to say that, oh, these banks were doing very well when the economy was doing well, to say that therefore everything was all right. And therefore the governance reforms do certainly need to be emphasized on. So this is something which, in terms of just to think through how, we're talking about state capitalism finally, right? And we sort of provided this framework in the report itself. If you look across the world, whenever government gets involved in commercial activity, it does so in three ways. There are basically governments like this, like the Singaporean government, which basically takes an approach of an investor, and so asks for primarily what is the return on the taxpayers' money, and adopts a hands-off approach to governance of public sector enterprises. The government can be an owner. South Africa, Brazil, etc. are actually good examples of this, where much like a Tatas or a Birlas would actually exercise their ownership rights of selecting the senior management, appointing the senior management. They do the same, apart from demanding basically return on their money. But finally, a third model, which actually has been seen a lot more in India and China primarily, is where the government acts as a sovereign when it invests in these state-owned enterprises, where the public sector enterprises in general, public sector banks as a particular case, become extensions of the government, and essentially become government government departments, and therefore then as agents of the government, government's policies then are basically pursued by the bureaucrats. The bureaucrats are the agents. They are the ones that then enact this role of the government as a sovereign, which leads to micromanagement and oftentimes power without expertise or necessarily accountability, because there's a lot that's going on. To pin down accountability becomes hard. And what is, I think, quite important for our discussion today is that the quality of governance and the value creation in public sector units, it's maximum in the first model when the government acts as an investor, and is by far the least when the government behaves as a sovereign. And I think that is something that is important for us to keep in mind. Now remember, these are correlations. I don't think for some of the more careful researchers here, this may jar a little bit, because I'm talking about just correlation, not causality necessarily. But I think there's still something to be learned here. The fact that there is that significant correlation. So if you take the spirit of the recommendations or the changes that we talked about, it is about moving the government that behaves as a sovereign right now to actually goad it to act as an owner. I think it'll be too much to expect the government to actually be an investor, but to move as an owner, and thereby bring in some of the important governance changes. So, this is about to ensure basically, adequate return on the taxpayers' fund. After all, these are, I think everybody here agrees, these are taxpayer funds. These are large investments. One can do in various kinds of calculations. I think the 2.25 trillion would have been 3 times the healthcare budget, or the education, annual budget. So you can do all kinds of counterfactual estimations how money could have been much better spent. So what we are basically saying here is government should exercise rights as owner, but desist from operating as a sovereign. Otherwise, the threats to fiscal stability will get aggravated. And I think the concern remains that the 2.25 trillion capitalization that has been put is still not adequate. It may actually, unless the governance is fixed, we may have another a round of similar kind of large capitalization that would be required. Again, taxpayer money being put into this. So just in terms of actually what have been the impacts, if you look at because of the capital shortage, take a look in particular at how growth has been up until 2016-17. In 2016-17, you notice industry, the growth of credit in industry has been 1.95% among public sector banks. I think it slowed down further in this year. While private sector banks, the growth has been quite robust. and which is reflected actually in the total credit growth as well. Also, if you look, and this is an estimation that we did in the paper that has been shared with you all about the exact amount of capitalization that will be capital that will be required after taking into account the capital that has been put by the government last year. And just to bottom line, actually, we believe that if the provisioning requirements are complied with, as they are required, we'll still be talking about maybe another 3.4 trillion. So we're still talking about very large numbers that are, I think, which raise quite a significant amount of concern. I think you can also look at maybe some of the debate that's happening right now. Maybe is, this is possibly the background for some of that. I think speculation, but something that I just wanted to. So just to give sort of one other sort of a sanity check on the number crunching that was done in the NAIC committee report. So that 3.4 trillion, which is which we estimate will be required, plus the 2.25 trillion that's already been put, works out to about 5.6 trillion, which was the estimate that we had provided as the realistic scenario. So the 2.2 trillion that we had estimated was the most conservative, which again says this was the amount that was estimated that we realistically required actually by the public sector banks. So, okay, so that's sort of a very brief, sort of pick. What are the? I think I'm going to do away with the mic because. Yeah, sure. Okay. So I'm now going to just focus on some of the on 5 key recommendations, what I think are crucial in order to sort of make sure that we don't have a recurrence of the same kind of problem. Going forward, and I'm going to summarize now, just mention it, but then go into detail into what are the kind of recommendations and what do I think is the rationale for this. First, I think it's about appointments, and finally it's about people. All board level appointments in public sector banks by a selection committee, and when I'll get into the details, I talk about how the Bank Boards Bureau does not serve that purpose yet. Creating real arm's length between the public sector banks and the Ministry of Finance. Second, run public sector banks as commercial organizations, albeit with both commercial and social goals. Number 4, create a level playing field between the public sector banks and the private sector banks. And finally, I think, and very crucial, modify the vigilance function, which the way I see it is actually in the public sector banks is broken. So let me sort of get into some of the details now in terms of what am I thinking about as possible actual recommendations, and I'll give you my rationale for it. So first is that all the appointments by a selection committee, which is now I'm going to just for our understanding, I'm going to use parallels with cricket. I think that is the fad now. So just to make sure that we sort of draw parallels and to understand what I'm really sort of trying to convey, I'm going to use parallels with cricket. So think about a team of selectors. So the recommendation here is that all board level appointments must be by a team of selectors, and this team of selectors should basically be comprised of banking experts of impeccable integrity, and this is where the spirit of the recommendations are as important as the letter. Dissociate appointments from the cabinet committee on appointments. So this is a specific recommendation in the first pillar, and why do I think about it? So let's start with let's do this thought experiment. We all know BCCI owns Team India. Now. And we know how the selection of cricketers happens. It happens by a committee of selectors, which itself is comprised of former cricketers, people who have played the sport, who can take judgments on the soft skills that is required. Imagine someone who's actually going in to face, let's say, Mitchell Starc, come Australia series, and you need to look at the temperament, which is not so easy to quantify in numbers, the soft information. But think about do this thought experiment and imagine that you have someone who's an administrator, let's say, and take your pick, my favorite is actually N. Srinivasan. Let's say you have N. Srinivasan who and his team goes and picks the cricket team. What would you have? I think we can all imagine actually what the outcomes will be. Not very good, I think, and that is what currently happens with the public sector banks. And this is important because people, especially at the board level, represent the key software. It's a hardware, basically think about the processes. It's really important to modify the appointment process so that the software is of high quality. And this is important because banking, as we all know, is a specialized activity. It's fine for me to be going, if I'm not let's say someone who works in banking, I may be visiting a bank for 30 years as a customer, as somebody who basically takes a loan. But that's one thing, much like I can watch cricket as I've been doing for the last 20 odd years, but then for me to kind of basically start telling Virat Kohli about how he should be scoring hundreds is a completely different thing. So banking is a specialized activity. Senior management therefore needs to combine strategic foresight, which I think comes from judgment and expertise, prudent risk management, and HR skills. For highly skilled activities, it's a selection by a peer group that ensures that those who have those who select have the ability to judge these attributes. Take, for instance, recruitment that happens, let's say, in academic institutions or investment banks, etc. It is the peers that basically go and select, and not necessarily administrators, because when you are as an academic, you're looking for some of the soft skills that basically will hopefully convey something about success in research. Similarly, here you are looking for the strategic foresight, risk management skills, and HR skills, which someone who's not an expert cannot actually claim to have knowledge of. Now, here's where I must mention that the Bank Boards Bureau, the name was what was used by the NAIC committee, but the form in which it has been actually created is far from what was intended in the report. So it's comprised of, it's headed by someone who has basically made his, a good person, of course, but made his fame as an auditor, not necessarily, somebody with expertise in banking. And the selection committee with only power to recommend. So, the way it's been structured is that the Bank Boards Bureau does not select people. It basically just has the power of recommending. It's instead, think about the selection committee only recommending, and then the administrators, of the deciding basically to put their nephew of, of a particular administrator in the cricket team. You will know what the outcome would be. So that's number one. Second recommendation, broad recommendation. So first one is ensure that it's by a team of selectors, and that's where the parallel to cricket that I'm using. Second, I think this is very important, which is this arm's length between the Ministry of Finance and public sector banks. So I talk about this think about the following. So you step into a public sector bank, you go to maybe ask for a loan. You go to bank one versus bank two, branch of two different banks. The processes, the people, the offices, they all look very similar. In fact, if you have to go and distinguish whether actually banking with bank A or bank B, you have to step out of the branch, go outside and read what is the board outside to know which bank are you banking with. That's how similar they are. And it's not an accident that these public sector banks have become clones of each other. I think that is extremely important to recognize. So what happens actually right now, what's happening is some top-down imposition of mergers between public sector banks. But what we have talked about is that the government must transfer its holdings in banks to a bank investment company. That bank investment company should be comprised of banking sector experts, technology experts. I think we all recognize that technology is really important. It has been important for the last 20 years, technology in banking, and yet we basically, count the number of technology experts that sit on the boards of public sector banks, and I think you can count them within, in fingers on one hand. Bureaucrats should only be sitting on the board as owners' representatives. The fact that, undeniably the government is the owner, and the owner gets to exercise its ownership rights and basically as the ultimate boss, but not as people who do all the micromanaging and setting the entire agenda for the public sector banks. So the government's powers in relation to the governance of banks should be transferred to the BIC. That's the main recommendation. What's the rationale for it? Currently, we have the Companies Act of 2013, which sets the agenda for how firms need to be governed. It's a piece of legislation that stays with the current times. Actually, it's not anachronistic. In contrast, if you ask basically, are any of the banks companies under company law? The answer is no, they're not. Because they all derive their existence from the archaic Banking Regulation Act of 1949 and the Bank Nationalization Act of 1969. Now remember, when they were set up, at that time the government had 100% ownership, and the governance, that was, so governance actually, the way a board should be comprised, what kind of people should be there, CA directors, workmen directors, all that is hard coded into the regulation, and based on regulation that was created for the government being 100% owner of these entities. And yet we basically have, so we, it's been almost now 50 years after, this act has been passed, and yet the banks get governed by basically this act. So, think about how anachronistic, therefore, it is. It hard codes all aspects of boards. There is no, think about all the different things that, that progressive boards today do, which is, think about succession planning, have a search process for appointment of directors. It's the directors that themselves, decide the CEO. None of that actually works in the case of public sector banks, because they derive their existence from these, from these acts. Again, let me use the parallel. Imagine you have actually, this is, think about, Sharad Pawar directing Virat Kohli or Rohit Sharma, basically given the, and all batsmen how to bat, saying, now I actually, all respect for Sharad Pawar maybe as a cricket viewer, but he's not played test match cricket. So, if he starts coaching these guys, what, how much would he know compared to somebody who's actually played cricket? If I'm asked to go and actually coach Virat Kohli, I'll say, oh, whenever there's actually a ball outside the off stump, just make sure you leave the ball. And if it is on the leg side, start playing, because that's how much I know, having watched cricket. And I can't get into the nuances because I don't know those nuances. I'm not the expert there. What would you have then? Actually, you would have, each batsman possibly turning out a clone of each other, who might become experts at running out each other. And I intend the pun there, that's the kind of, and that is what you currently have with the public sector banks, which is each one of them is a clone of the other. As a result, we have a banking sector in India that has one large, humongous bank, effectively in economic terms, that occupies 70% of the banking sector. And that's why what happens, whenever there's actually, when the economy nosedives, you have some private sector banks who actually get affected, as they have, because their DNA is different. You have other private sector banks who escape the, who don't get, caught in the fire, because you think about a Kotak, you think about, let's say, an HDFC, their DNAs are different. They actually are more into retail. In contrast, whenever things basically, economy nosedives, every public sector bank, maybe to different magnitudes, but gets affected. Why? Because there is no diversification across them. They're actually clones of each other. They do same kind of lending in the same sectors, and end up, sort of suffering the same consequences. Excessive homogeneity. And think about this, think about from the regulator's perspective, that you actually have one large bank, effectively economically, that is, 70% of the banking sector. Think about the systemic risk that it creates in the process then. And such homogeneous distress does not occur in the private sector banks. And because of the large systemic risk, whenever there is actually a downturn, all these banks are affected, and then taxpayer money has to be poured into recapitalization, which is what is happening. And and this is also, think about it, if you this is, I think, simple principal agent theory that we all learn, in our first year economics classes, that if I'm an agent, I actually would try to do what is basically best for me. Now, if I'm the agent that actually has to run, has to basically govern, let's say, 30 banks, ideally what I should be doing, if there were 30 different owners, each of the owner would understand what is the DNA of the bank, and would try and come up with policies that are actually suited optimally to the DNA of the bank. But if I'm one agent that is actually, giving directions to all 30, then it economizes on my own cost of actually trying to say, let's just uniformly, go and give, whether it's asset liability management or whether it's actually going and implementing core banking systems. So the directives that go out from the Ministry of Finance, it says to all scheduled commercial banks, asset liability management. All scheduled commercial banks go and implement, core banking solutions. So, and this process has continued ever since nationalization, 1969, at which time the DNAs of these banks were different. But now that, over 50 years of actually identical directions to these banks have made them clones of each other. And that is something which is important for us to recognize. Therefore, the arm's length between the Ministry of Finance and the public sector banks is absolutely important for governance actually to improve here. Similarly, think about, I think this, if you're going to hard code, if you're someone who's not an expert, you don't have the soft information, expertise to be able to give specific directions. You would basically say, if I were telling Virat Kohli, I'd say that, when Mitchell Stark is bowling, just measure. If it is, the ball is six inches outside the off stump, leave. If it is actually inside, then you basically you play the ball. And in the process, what would Virat Kohli do? Of course, now that you are the boss, he has to basically go and listen to you. He'd do, and he'll miss out on a lot of opportunities of hitting boundaries as well. And that's what basically happens, because the soft information that is so critical to banking, gets lost, because you have non-experts, people who basically are not being bankers, telling those people who have been in the banking industry. Imagine someone who becomes a public sector bank chairman, has spent 35, 40 years in the banking sector, understands banking, and yet you have somebody who's don't mistake me, extremely smart person, but a generalist trying to tell what the expert actually should be doing in his or her area of expertise. And that is what you have currently with the public sector banks. And that's basically now. Some people may come back and say, no, this is required basically because you're talking about possible in cricket match fixing. So we have to be telling them, what they should be doing to ensure there is no match fixing. But this is not the way to, if you want to fix fix the problem of match fixing, this is not the way you would go about it. As we all know, actually, the right way of fixing match fixing is different. This is not the way to go and do about it. But that is currently the solution that we have. The third recommendation that I have is, again, run public sector banks as commercial organizations. And this is true not just for public sector banks, but for a lot of our private sector, of our public sector enterprises themselves. The boards of the public sector banks should be the ultimate decision-making authority, which is how a commercial organization should be running. The public sector bank board must be answerable to the government only on the outcomes, and those outcomes can definitely include both commercial and social goals. We are an emerging economy where there are several market failures, so there should be social goals that banks need to be pursuing, but it must be the public sector bank board that is made responsible for these outcomes, both commercial and social. If the government is not satisfied with the achievement of these goals, then as the owner, the government has every right to replace the MD and maybe replace the entire board as well, but eventually appoint these people and let them deliver on the goals that you have set for them. But all processes and internal decision making must be left to the management and the board. Give them the outcomes that they must be pursuing, but let them go and manage the banks. For instance, one of the things, I sit on the board of Bandhan Bank, and one thing we are always careful about in the board meetings is to make sure that we are not managing the bank. What is, important for us is to give strategic, direction to the bank, but micromanagement is something that is best left to the management, and that is how commercial organizations actually run, and that is how, the government should be thinking about public sector banks as well. Boards should be structured according to company law, so at least 25% of independent directors, which you don't have currently in the public sector banks. Remove these categories of CA directors, workman directors, officer directors, all of which right now are hard coded in the regulation itself. Again, let's use the same sort of rationales. Let's say you actually have, and we have this pet phrase in India, which is that national service responsibility. Okay, imagine, let's say that the Indian cricket team is told that it is their duty is not just to win cricket matches, but they need to be also entertaining the public. Why? Because that is their national service responsibility, to be entertaining the public. After all, they're representatives of the Indian people. What will happen? Imagine, actually, suppose that was the objective that was given to the Indian cricket team. You will have actually the openers going and trying to hit 6 from the very first ball, reckless, batting, to entertain. Why? Because that is their objective, to entertain the Indian public, and they will use the national service responsibility as an excuse for their non-performance, because every time when they actually try and, let's say, if they don't grind it out, they always have this as a fallback to say, I'm just doing what you've asked me to do, which is to basically entertain the public, because that is my national service responsibility. But what basically, and what is getting done, thankfully, at least from the cricket's point of view, is that the objective for them is winning cricket matches. And if in that process, the public gets entertained, Great, that's an icing on the cake, and that is how we should be thinking about actually about state capitalism as well, about public sector banks. A commercial organization can have commercial and social goals. We have, for instance, priority sector lending in India. All banks have to cater to priority sector lending. But to achieve its goals efficiently, the public sector banks must be given explicit commercial goals. Social goals, in fact, can be priced in. For instance, let's say you're doing Jan Dhan and there's something which is a national cause. There could be transfer pricing that can be worked out to make sure that, because you're doing something that is not necessarily, privately profitable, but is socially optimal, it's good for the economy. There's a way of possibly transfer pricing that can be worked on to ensure that eventually the public sector banks are evaluated on parameters that can be quantified. Of course, we can quibble about, what might be the way of transfer pricing, but there has to be an explicit objective. Why? Because so that the management does not hide behind saying, oh, we're not able to generate ROA, we're not able to generate ROE because we have to serve, do national service. And which in much the same way as, let's say, the Indian cricket team says, oh, because we have to entertain, that is why we cannot play carefully, we cannot basically win cricket matches. And that's the kind of outcome that you don't want. The presence of social goals, as I said, becomes an excuse for non-performance. And this is something, I think, none of this, by the way, I must say, is rocket science. I think these are all very, very basic things. It's just about, going and plucking these low-hanging fruits. The board should be the ultimate decision-making authority in the commercial organization, as I said. Similarly, in PSB, in the public sector banks, once the board is comprised of capable people, let the board of PSBs make the ultimate decisions. Let's remove these categories of CA directors, workmen directors, etc. Fourth recommendation is about creating a level playing field with private sector banks. All banks must be regulatorily mandated to fulfill some social goals. It's part of the license. When you get license in an emerging economy, there are, we do have market failures, and therefore, some amount of social service is required. I think there'll be a pushback on this, saying that, oh, that means that we're going to encumber some of the, private sector banks. But what I'm trying to actually say here is that let the government not really, sort of undermine the very banks it owns, by basically putting a bulk of the load for fulfilling social goals on the public sector banks. And for instance, public sector banks right now cannot hire from MBA campuses and engineering campuses. They have to, the Supreme Court has basically directed them, and they can't go and hire people. And that basically is a big HR issue in the public sector banks itself. So think about the following. I mean, again, another thought experiment. Let's say you have, the official Team India, and BCCI also licenses one other Team India. Let's say call it unofficial Team India. And just think about it, actually. I think, this may sort of illustrate what I'm trying to say, the current status of the public sector banks. The official Team India is required to fulfill its national service responsibility of entertaining the Indian public, and therefore doesn't necessarily focus as much on winning matches. No such constraints for the unofficial Team India. They can pursue winning as their sole objective. The official Team India cannot select cricketers from national cricket academies. The unofficial Team India can go and select the best talent from wherever they get in India. You have fixed salaries for official Team India, no incentives for winning, and yet unofficial Team India has strong incentives for winning. They basically they go and they're paid for winning well. Good players who prove themselves to unofficial Team India can actually migrate. Basically, they get poached by the unofficial Team India, and then the official Team India is left with those who actually are not poachable then. If this were going on with the cricket team, you had, let's say, an official cricket team and an unofficial cricket team that was doing this, we would all be actually screaming hoarse about what is going on. We would be asking, which side is the BCCI on? And yet we don't ask which side is the government on, because this is exactly what goes on with the public sector banks versus the private sector banks. The public sector banks constraints in each of these ways, the public sector banks versus the private sector banks. For instance, basically there are social goals that the public sector banks have to fulfill. Private sector banks not as much. Take Jan Dhan, for instance. The entire load had to be picked up by the public sector banks. They cannot go and select the best people from campuses. They have fixed salaries. There is very few incentive compensation is not very strong. And as people start in the public sector, once they reach middle management level, they're doing well. The private sector banks then basically go and sort of hire from there. And these people also find it incentive compatible because the salaries are actually higher. As a result, you have the people, either those who are staunch patriots and then who think that I want to serve the nation's cause by being with public sector banks, or those who actually are not good enough to get a private sector bank job. Those are the set that are left with the public sector banks. And this is the current situation, which actually would make us, I think because cricket is such a fervor, we actually would get sort of so moved over some if such a situation prevails. But unfortunately, with the government doing the same thing with the public sector banks, there isn't as much of wringing of hands. So this is basically, I think I've talked about it. Let me talk about the fifth and final recommendation, I think, which is quite important. I wrote a piece a few months back about after some of these some of the public sector bank actually former chairman were charge sheeted. And this came up in the SBI conclave where the CVC was there as well. The vigilance function in the public sector banks is broken. Vigilance should be made bank specific. CVC, the Central Vigilance Commission, should not have any role to play in the vigilance function in public sector banks, because on the one hand you have actually the corrupt who repeatedly get away, despite CVC's oversight. For instance, and this is something that I've found it, Kingfisher was given loans using brands as collateral. As a finance faculty, the basic thing that I learn is if I get something as collateral, which is land or let's say or property, the reason I take that as collateral is because when the firm is doing poorly, the value of that asset does not fall. And to take a step back and think about what happens with the brand, the value of a brand is very strongly correlated with how the firm is doing. The brand is worthless when the firm is not doing well, and as a lender, I only care about those states of the world when the firm is not doing well, and yet I go and actually take brand as collateral. And that is basically something that escapes the oversight of the CVC. On the other hand, you actually have those who possibly are upright but may have taken some judgment calls, who basically are sort of pursued upon this business of actually equating bad judgment on the one hand with malified intent and not distinguishing between the two is something that has really gone on for too long with the CVC function, because CVC repeatedly uses hindsight to equate bad judgment. They basically, ideally, and this is the way the vigilance function works, all over the world, which is that they basically need to prove, if you have to show malified intent, the money trail is the smoking gun. And that's not something that is not required. And we all know very well, I think I've talked about already, that banking is something that requires significant expertise. People in the CVC, and I don't blame them. They're actually not necessarily people who spend so long in banking to be able to understand that this was a judgment that was based on soft information versus something that was basically, malified intent. The real bad outcome of this is that upright people who want to do good work, they basically say, why should I bother? Why should I bother? Basically, I'll take a judgment, and if that judgment call goes wrong, I will be hounded about, and my retirement, sort of post-retirement life will become quite a mess, which is what is happening with a few people, unfortunately, whom I know them very well, of unimpeachable integrity, and yet that is what they're facing. So what should be done is, and this is what private sector banks do, they have bank-specific vigilance functions. The advantage of that is that firm-specific information, stuff like cooler talks, or when you go for a coffee, you talk about, okay, individual X is doing activity Y, which is basically not that great. That kind of information that floats around inside the firm does not get used when you actually have vigilance that is being done from outside the organization. So this is something that actually, if you think about this from just the theory of the firm, what kind of activities should be housed inside and what should be housed outside. Whenever you have an activity that requires firm-specific information for it to be successful, that activity has to be housed inside the firm, and that basic aspect of what we learn right from Ronald Coase's work on theory of the firm, that is getting violated right now in the way the vigilance function is administered in the public sector banks. So I think it's time for me to summarize. As I said in between, none of this is rocket science. I think we all know many of these are some things that we would say are really basic stuff. It's not, none of this requires a NASA scientist to come and tell us that these should be done. But I think the bottom line is that if we continue to pour money without changing the governance that underlies the public sector banks, I think we should not be surprised if we have a repeat of the same thing over and over again. And just to summarize, these are the 5 broad recommendations that all board level appointments in PSBs should be by a selection committee. Create real arm's length, and I'm really emphasize the real part, not just in spirit, arm's length between the public sector banks and the Ministry of Finance. Run public sector banks as commercial organizations does not mean that they have to be commercial organizations only pursuing commercial objectives. They could still be pursuing social goals as well, but make them accountable on some measures that actually are quantifiable. Create a level playing field between public sector banks and private sector banks, and modify the vigilance function because it is broken. In summary, this is about basically moving the government right now, which acts as a sovereign in its role, with all public sector enterprises, and in particular the public sector banks, to the government being as an owner, acting as an owner, which means it asks for a return on the taxpayers' money and also exercises its ownership rights of putting the right people, and if they don't deliver, then definitely change those people. That's sort of the spirit of the recommendations. Thanks a lot for your patience. I'm really looking forward to Ila's comments.
Thank you for having me here. Just wait for the slideshow to come up. Though I must say that the slideshow is about the paper and not the recommendations of the NAIC committee, which was the presentation. But of course, let me just summarize the paper also for you, because that is the evidence that is provided in the NAIC committee and what was really behind the recommendations that were made. It analyzes the asset quality position of private banks and public banks. It looks at loan quality, performance indicators, again, throughout contrasting private and public sector banks. It shows you the non-performing loans, and these are by now much better known than perhaps at the time when the paper was being written and the committee made its recommendations. And it does, of course, say that, we all know that the public sector banks have performed much worse on almost all indicators compared to private sector banks, that they have far bigger non-performing loans, their stressed assets at that time, and so on. It does, of course, point out that it is also true that private sector banks have been underreporting some of their losses. I mean, I think one of the figures was 500% for one of the banks. So we got into this debate of, what sort of auditors do they have, what sort of supervisors do they have, and who was doing their job well or not, and that there might be some evidence of evergreening in the private sector banks. So maybe they look a little better than they actually are compared to public sector banks. The paper and the report is, I would say, not about banking reform, but about reform of public sector banks while they remain public sector. Just to emphasize this distinction, it is not about how India can get a well-functioning, growing banking sector that provides credit to small and medium enterprises, a function that banks do well, and so on. It's not about the banking sector, it is how to reform public sector banks. The authors, as it was emphasized, said that there would be a need for recapitalizing. I won't go into the details. And then they propose a set of reforms, that is a single law for regulation, so ownership neutrality in regulation. Currently, the the BRA, the Bank Regulation Act, only is applicable for private sector banks, whereas the 1969 and the 1980 Bank Nationalization Acts created the public sector banks. So there is lack of ownership neutrality there, that there should be governance they should all be made companies, so they should be under the company law. Currently they are not under the company law. Public sector banks have been created by special under the PNA. It proposes a holding structure and also discusses some of the other proposals that have been proposed, like the like narrow banking and consolidation of banking. Now, the authors talk about how banks, public sector banks, should pursue a profit objective, right? Currently, what is the main problem? I think the main problem as it comes out is that you don't know what these banks are doing. What is the objective of public sector banks? Is it to make profits? Is it to follow social goals? I mean, after all, PSL, a priority sector lending, is done both by private banks and by public banks, public sector banks. So you can't really say that it's not a goal that has also been imposed upon private sector banks. So let's go back to the question of, so why have public sector banks if they are going to be profit making, right? What is the objective of having public sector banks? What does the literature primarily argue? That you have that private lenders are not able to fulfill their responsibilities in terms of where social returns are the highest. So that is why you need public sector banks. I mean, let's go back to the bank nationalization, the objectives that were set, rural bank branches, reaching out to the poor, reaching out to small enterprises. So these were places where social returns would be high. And because private sector banking is supposed not to be able to fulfill these social goals, that's why you need public sector banks. So I just want to put that on the table before we start thinking that they should be making profits. Then we might as well have private banks. Why have public banks at all? If you look at some of the studies which compare that after nationalization, the spread of banks, the spread of outreach compared to private banks, which grew faster, public sector banks have less spread of intermediation than private sector banks do. The other big problem, as we are seeing every day today and every day, I think, in the newspapers in the last few weeks, is that state ownership creates a moral hazard. You know, you think there's a sovereign backing, you keep on making losses, the government keeps recapitalizing these banks. I think the CAG made a speech recently where he said, this is a word for subsidies. So that, you know, money is put in again and again, and banks, PSBs continue to function as they did. There is also evidence, and this is a paper by Viral, that suggests that because there was a sovereign guarantee, after the global financial crisis, deposits moved to public sector banks. There was perceived to be a sovereign guarantee. In effect, I think most of us don't know. Is there a sovereign guarantee? I've heard this question being asked very often. Is it that in public sector banks also you'll only get your 1 lakh deposit insurance? Or is it that there is a sovereign guarantee? I mean, if you do a poll of depositors across the country, or let's even do it in this room, I doubt that we know the answer very well. So there is this perception of sovereign guarantee, which really got deposits out of banks like ICICI, and they moved to public sector banks after the crisis. So what is the problem? Now, putting it politely, they are treated as the agent for furthering the government's social sector agenda. Putting it rudely, I think the Prime Minister calls it phone banking. So they suffer from multiple objectives, bureaucratic interference, political interference, poor HR practices, which you certainly highlighted, and that's one part of the story. And there are difficulties that arise from, there is an RBI representative on the board, there is a DFS, that's Department of Financial Services, the government's representative on their board, and so on. So it's not very clear that even if we had these governance reforms, that we were, because given what their objectives and their role and functions are, that we would get a change in how they perform. Now, if we look at what has happened to the report, I mean, while, as you admitted, that there was a proposal, but what actually happened didn't seem to be have much effect, or what was implemented wasn't exactly in line with the proposals that were made by Dr. Naik. A lot of, even now, 2.11 lakh crore may not be sufficient, more may be put in, but the question is that after even more being put in, are we going to see a change in the performance of these banks? The legislative changes which would require a repeal of the Bank Nationalization Acts, and that would be as difficult as privatizing these banks. So one of the things that comes out in the paper is we are trying to find a solution for the time being, because we are not going to privatize these banks, because the mood of the nation is not to privatize them. Am I right? And yet, what would it require? What your recommendations would require is a repeal of the BNAs. I mean, those of us who know Parliament today, tomorrow, and I think many parliaments to come, are we going to see a repeal of the BNA? This is from a CAG report that looks at recapitalization by government over the years. You would have thought, so the last one is the 2.1 trillion. But throughout history, I mean, again and again, many of these banks have been recapitalized. Sometimes they start looking good for some time, and then they fall back into trouble again. So the question that we should be asking really is it enough to have these governance reforms? Will that give us a banking sector that we would like to see? So it's not just about improving what is happening in the public sector banks, but it is about the banking system as a whole. Now, the way I see it is that the moral hazard created by the existence of public sector banks and them being big enough to be 70% of the banking system has actually weakened the regulatory capacity of the regulator. Most of the time, the regulator feels, okay, if the bank's not going to go bankrupt, it's not going to fail, I can sit back. And in fact, I would argue that that gets reflected also in the way they, the 500% difference in private sector banks, or the way supervision of private sector banks has also been very weak. Because the regulatory capacity of the regulator and this banking supervisor, who in general feels that, nothing will happen. And when nothing is going to happen, that's when you sit back and you don't really do your job well. You don't develop the capacity to understand which banks are at risk. And then suddenly, you also try to find ways to let them, regulatory forbearance. And then suddenly February 2018 comes and you say, oh, oops, now, I realize things are very bad. So the regulatory capacity of the regulator has fallen behind in this situation, partly due to the existence of a very large public sector banking system. So then, what do we need to do about it? The model could be the same model that was followed in telecom, or in aviation. And that model is to allow entry of private banks in this case. Now, what we see is that there has been very little, I'll come back to this, there has been very little progress made on allowing the private banks into the system. Last, I think, 13 years, 2 bank licenses. Yes, Sugu, am I right? In 13 years, 2 bank licenses have been given. There was a discussion paper in 2013 that talked about bank licenses on tap. But apparently the guidelines for giving those licenses are so tough that there has been only one applicant who has applied for on-tap licensing, and no licenses have been given for banks as such. What has been done is we've carved out payment banks, okay, or we've carved out something else. But normal, regular function of banking, something that would compete with the public sector banks in the space they're in. I mean, we didn't say we'll allow telecom, but only those who can, talk at 7 in the morning and not after that. Or we'll allow airlines, but only those who do X or Y. So we're not allowing them to really compete with the bulk of what the public sector banking business is. So that's one critical thing. Now, to do that, there is another element that is missing in our story. If you allow a lot of entry of private banks, of course you will do regulation well, and we should do, and we'll talk about that, but there can also be bank failure. So for bank failure, you need an orderly resolution process. And that is what, why there's a proposal to bring in the FRDI bill, the Deposit Insurance and Resolution Corporation bill, that you allow entry. At the same time, you have a mechanism so that if and when you see failure of banks, you are able to resolve them in an orderly manner. It should, in principle, give the regulator comfort to allow private entry, to allow new banks to come into the system. So the pillars that are required for a reform of banking is, of course, I mean, of course you should, the kind of things you pointed to are not something one would disagree with, that the public sector banking system should be improved, but that won't be adequate. And so what you would also need is entry of private sector banks, so that a competitive environment. Secondly, what you would need is a orderly resolution framework. And third, a regulatory mechanism, a regulator with adequate capacity, proper regulation making processes, good governance. I mean, if I may talk about what's happening today, the regulations being made. Last year, the Reserve Bank of India issued about 360 guidelines, circulars, master circulars, out of which roughly about 60 were what we may call regulations, those that govern the way banks or other things that RBI, I mean, there's a lot more that RBI does, but those that govern their functioning. In other regulators both around the world as well as in India, when regulations are made, the regulations need to be brought to the board of the regulator. But in RBI, they are left to not just DGs, but even very lower levels within the organization. Now think of what is a regulation. You can be jailed if you're doing something that goes against it. What is a regulation? It is, Parliament has given you the power to make subordinate legislation. So these are laws that you make. This power has to be exercised with care. If I go back to the board meeting today, we should not have been discussing A, B, and C regulations of the RBI. All regulations should have been made in a proper manner, discussed in the board, where the board offers an oversight to the management. They should have been first put on the table by the board with a cost-benefit analysis, with a process of consultations with stakeholders, with a response to those stakeholders, and a revised regulation coming back to the board. That is the process that has been recommended by FSLRC, the Financial Sector Legislative Reforms Commission. That is the process that in 2015, the Financial Stability and Development Council, which includes all the regulators, had adopted in a handbook of regulation making processes, which is on the website of the Ministry of Finance. Because this was not followed, what we have today is that we are, today everybody is an expert on PCA. Every journalist, every TV commentator, everybody understands not just PCA. People also seem to understand what is RBI's equity capital, or what are RBI's reserves. Half of them call the forex reserves RBI reserves. They're not the same, but people are, just because everybody is an expert today. And that has come about because we did not do the reforms for regulation making processes that we needed to do. It's not that they haven't been on the table. They've been on the table since the FSLRC report was submitted in 2013, and they have been much discussed. And yet, there has been a lack of enthusiasm on the part of the regulator to adopt some of these ways. So I would say, and I only have 10 minutes and I don't have time to go into what are the other elements of what was recommended. But what I would say is that it is absolutely critical to have regulatory reform as well as more competition, which can then, maybe if we are not in a position to repeal Bank Nationalization Act, but give us a banking sector where there is a lot more entry, exit, and that sector fulfills its role. Thank you.
Great. So now we have about 25 minutes Q&A. Let me first start by setting the context, the global context within which we are talking and discussing this problem. In the last 10 years, many countries have undergone banking sector crisis, the US and China included. Of course, the US had the massive TARP, the Troubled Asset Rescue Program. In the Chinese case, I'm not familiar. I don't know anyone who is familiar with exactly what happened, and we aren't talking much about it, but countries do go through these cycles, and that is just to give you a sense of where we are and how moving ahead has to be done in a way that is long-term sustained and not recurring, the kind Sugu brought out. But Ila's point went beyond the public sector banks to saying that, well, if we only took care of the symptoms and not the disease, then we are likely to be faced by the problem. Which means governance reforms of the public sector banks cannot be limited to the public sector banks. Essentially, it is about competition, injecting more competition, and over and above that, also building regulatory capacity, meaning RBI has to also increase its capacity to be in a position to do real-time regulation of the kind which is required for a strong banking sector for an emerging market like ours. So let's now take questions from the floor. Please identify yourself and ask away. The mics are going to come around. Yeah.
You said that there is no separate service in telecom, there is no separate service in airline. When we were writing telecom regulation, I was almost compelled to write regulation for a rural telecom service. That we get these private fellows and we give them small amounts of spectrum and they deal with rural areas. Unfortunately, I resisted the temptation. Airline, of course, there is a separate service in the regulation. That separate service is, these small town airlines which are called, they're very successful. One airline is very successful in the south, which is under that license and not the general license. So there is a service in airline which is a separate service. I was looking for more discussion today on a recapitalization of public sector banks. I know that there have been failures in USA, there have been failures in China. There were massive failures in Southeast Asia. Earlier, they were all the Southeast Asian tigers. and then all of those countries and the banks and the regulation, everything failed. So I was looking for information on recapitalization. Does government in all countries do recapitalization of public sector banks, or there are any other methods? That is my main.
In cricketing terms, I just Googled it out, and I found that if the heads of BCCI and bank board bureau says that my role is of a night watchman, how the banks can perform well? I don't know whether this was said in context of the banks or BCCI, but one thing is clear that yes, cricket is doing very well compared to the banks. Thank you.
Yeah, so I don't know if my first issue is actually with you, Shamika, on false advertising. I found virtually, no discussion of NPAs. Now, these are all sort of systemic issues. This thing, what you've talked about, I can go back at least 40 years. I remember a discussion with Arjun Sen Gupta, after he had did this committee on state enterprises in the 80s on what it meant for the banks, and because we were trying to. But what I'm trying to say is today, given the governance structure that we have, and actually the bigger problem with the financial structure of the financial sector and the NPA problem, it is, to address whether it's recapitalization, but the approach we need to take to address this, bad bank, good bank, etc., all of them have to do with governance, several of the things. What about those? I hope we can have a little bit of a discussion on that.
Well, let's do one thing. In the spirit of fulfilling people's expectations, and we do have a lot of expertise in this room. These are experts who have been writing on the subject. Perhaps if you could quickly answer this very specific question that Mr. Badal has raised. Is recapitalization a usual form of response for public sector banks globally? That's number one. And then perhaps a little bit on the NPAs. What are possible? I know that the bad bank has been shot down many times by the government, but perhaps this is a discussion forum. You're open to suggestions.
Can I just respond to Ila's comments at some point? Maybe later, or should I respond first? Okay, so let me first. I think Anupam's criticism actually is well taken, and I would take the blame all on myself, not on Shamika. I felt it would have been better to talk about some of the changes that are required, because I felt that a lot of the issues in terms of NPS has been debated a lot on, but that said, let me, I'll come back to after I respond to the first question. I think.
Wait 1 second.
Mm-hmm.
I do think we should send the audience here a copy of the paper.
Yeah.
Because the paper has a lot of details of the NPAs of different banks.
Yes.
And systematically, how do you compare public and private?
Correct.
That might be.
Yeah, and I think there are, so we've done estimations, the actual NPAs and the extent of distress. There are sort of data out there which I think you can refer to. Now, to a specific question of how how governments recapitalize, when the government it does sort of own the banks, and they called in different ways. Happens in South Africa. It happens in in China. You have Brazil. Many of these countries. Typically, we get if it's the Anglo-Saxon countries, US and UK, where government does not own the banks, and therefore we don't learn as much about recapitalization. But in other countries, to my knowledge, whenever there is distress, the government does go and sort of intervene. Germany, for instance, there are some banks that are actually owned by the government, and where there is the recapitalization that happens. What forms of recapitalization, that it's usually in the form of equity infusion, but it could also be where you sort of dilute the ownership and let private investors come in. That's the other form that broadly this takes. I think to respond to the broader question of distress, and let me first talk about the bad bank idea itself. And I had written about this, in an op-ed article some couple of years back. I think the major pushback on the bad bank idea has been with respect to the moral hazard that it will create. I think so. People have talked about the benefits from it, which is number one. What has been lacking, I think the reason the distress has gotten lot more painful is because the expertise to deal with stressed assets, restructuring, a lot of that has not been adequate on the real side, and even whether with ARCs, and for instance, a lot of the HR problems also have contributed to this, because for instance, when you have to sell to an ARC, you have to take the hit on, suppose it's a 100 rupee loan on which you're only getting, let's say, 60 rupees. Then, that particular quarter, you will have to write down the value of that loan by 40 bucks. But in contrast, if you continue to treat that as, let's say, as an NPA or as a restructured asset, you can continue provisioning. And with the kind of horizons that our, chairmen have, which is 1.5 to 2 years, they always can say, okay, why do I deal with it? Let me kick the can down the road. And that problem, unfortunately, will not get solved even with the bad bank, because you will require the public sector banks to sell these assets to the bad bank. And in fact, even after, for instance, the bankruptcy code was brought into play, there was a significant reluctance on banks to take these firms to NCLT, and precisely because of this reason. So while some of the problems that were there even with the ARCs, those would continue to remain with the bad bank, the moral hazard that it would create, I think would have been significant. That was the reason, I think, and from sort of talking to some of the policymakers that time when this idea was being mooted, that's why the idea was not sort of pushed more, because the cost, I think, and the cost may not be seen now. Cost actually could come at any point in time in the future, the moral hazard, which is why the idea was sort of not pushed through. On some of the other aspects of, I think, on just to talk more on the distress itself, I did bring it up here as well. I think even with restructuring, for instance, one of the when a borrower is in distress, the big problem is of debt overhang, and the fact that because the borrower suffers from debt overhang, the borrower is not willing to invest in some profitable projects, because the benefits from that will go to the bankers. And this is and so world over, banks therefore do restructuring, where what they do is, if you have a 100 rupee loan, and let's say the actual value of the assets of the firm right now is let's say only 90. If you write down the value of those of your loan, instead of demanding 100, if you say I'm willing to take 85, then it creates skin in the game for the shareholders to say, okay, we will at least get 5 now with you having written down from 100 to 90, so to 85, and therefore the project that was wouldn't have been acceptable to shareholders happens now. But that's how it happens world over. Think about the constraints that get faced in the Indian context. Let's take Kingfisher, for instance. Kingfisher had an exposure of about 9,000 crores. Suppose, let's say, I was the chairman of State Bank of India, and I say that, okay, I am willing to now write it down to 6,500 crores, so that, you have, let's say, 100 crores to be able to go and invest the project, you get some skin in the game. There are a zillion questions. First of all, basically people will say, oh, here's a borrower that has clearly willfully defaulted, maybe, has not paid employees. How is it justified that they're actually reducing from from 9,000 crores to 6,500 crores? Not just that, even if I as a chairman would basically first worry about, tomorrow I might get a call from CVC saying, how much money did you get? How much did Vijay Mallya pay you? And I would then think about, after I retired, I'd basically be running from pillar to post, trying to take care of cases, etc. So I would say, why do I bother actually? Let me pass the can on to the next guy, and let the next guy deal with it. And that's exactly what has happened, which is what has really accentuated the problem, because one of the key aspects in with distress is you identify distress early, and that's where I quite agree with what Eli is talking about on the banking supervision. I think elsewhere I've written about how I think, in general, banking supervision has been quite poor. So the key is to identify distress early and to fix the problem. Longer you actually let it sort of fester, the problem becomes greater. It's like, so for instance, one of the examples illustrations I use is, think about a heart patient that has needs a bypass, and you continue putting band-aids on the top, on the left-hand side. What you'll basically get is, someone who needs a single bypass now needs a quadruple bypass, which is the issue, and that none of these problems actually get solved with the bad bank or with the distress. I think that's where some of the governance changes that we've talked about are important. And now let me just quickly respond to Ela. I think I do not disagree with any of what you talked about. I think, and the fact that the objective that you are asking for is the right objective, which is that what do we do about the banking sector? I think that, and that's absolutely well taken. And the fact that, we have to ask the question, why do we have public sector banks? I think I peripherally referred to it, and let me make that very clear what sort of idea, we have, which I said that you can have public sector enterprises, including public sector banks, who are entrusted not only with commercial goals, but also with social goals. But what is absent right now is some form of transfer pricing, which basically enables you to quantify it, albeit in an imprecise manner, to basically what is the cost of performing those social goals. I think, in our mind, we're absolutely clear that we need public sector banks because there are market failures. There are areas of the economy which basically do not get credit and which public sector banks have to cater to. But those social goals actually, I think what is important is, even with social goals, you can still try and quantify what is and judge them on some performance measures. Right now, I think, and performance measures doesn't mean only profit. I think I wanted to make that very clear. Second comment, which is that I think some of what we've outlined here are necessary conditions, not sufficient. I think some of what you've added are definitely complementary to what I've spoken about. Therefore, because I think it enables us to get to sufficient conditions. Some of what we've talked about, I think we view it as necessary conditions.
Good evening. My name is Sanjeev Ahuja, and I'm a resolution professional. So, in the context of insolvency bankruptcy code, I'm interacting with the PSBs in a different capacity. Right now, what has happened is, as we discuss, the mindset and the DNA, that is so important, because this very mindset and the DNA actually led to the NPAs to a greater extent. Now, the same mindset and the same DNA is being expected to rectify the situation. So now, once we interact, and the kind of blank faces we kind of see either in the COC meetings or whatever, wherever we are supposed to kind of expect them to act, take decisions, be decisive. And as you are saying, in terms of awareness and taking calls, is practically zero. So how do we expect that, though we have diagnosed the problem, here it is, here is the new law, the intent is right, but the biggest stakeholder, which is the lender, he again takes a back seat, and this entire 270 days, what we have been talking about, you've seen the top 12 cases, what has happened? RBI had to bulldoze all that thing in spite of 450 days now. In 8 or 10 out of the cases, we still don't have the clarity. So the point is not just the diagnosis bit, it's also the implementation of what you've come out with as a action step. So I think there has to be a good emphasis on this particular part.
Yeah, we'll take it.
I work at NIPFP. So I was going through some of the examples you cited, and I think there are counter examples for some of them too. So the first one, selection by experts. Indian judiciary is selected by experts from the Indian judiciary, and it is probably the slowest and the most dysfunctional wing of the government today. On the contrary, when you look at, say, CAG, or when you say look at election commission, they are appointed by the political executive, and election commission is far more efficient than the Indian judiciary today. And again, no questions about fairness. You pointed out that all the public sector banks have gone bad this time. I think Indian Bank is a counter example to that. It was the bad boy of the banking crisis last time. This time it has been able to avoid PCA and is adequately capitalized. So it's an interesting counterfactual to the point that there's complete homogeneity in the banking sector. On your point on HR practices, I would like to point out that the banks did something on HR practices. I don't want to take the example, but I have to, is SBI Caps. SBI Caps was a subsidiary of SBI. It has almost the same as private sector HR practices, very high salaries, bonuses. It was also the due diligence agent for almost all the consortium lending. So the loan to Kingfisher was done by SBI Caps. So we had a system by which a company was created which had perfect HR practices or comparable to private Indian sector HR practices. It was a subsidiary of the SBI. It had separate recruitment processes. SBI Caps used to hire directly from the IIMs. And the thunderous failure of all the consortium loans where they did the due diligence, the valuation of Kingfisher was done by SBI Caps at the brand. And the last one on the question of vigilance. I would give another counterfactual to this. All other government entities get audited by the CAG. The only set of government PSUs not audited by the CAG is the banking sector. And the argument that you placed was exactly the same, to exempt them from CAG audit. These are complicated financial firms. CAG does not have the expertise to audit them. Therefore, they will audit on their own. And they will have their own self-audit mechanism, just like you're suggesting their own self-vigilance mechanism. We have seen the horrors of self-audit in public sector banks. I mean, what PNB did couldn't, match two registers is an example of self-audit systems. On the final point of the question of why PSU banks don't let things go to ARCs, I think the role is in RBI regulations. RBI allows NPS to be valued artificially highly in the bank than the market system. 70% of the collateral value is still allowed to be on the books. We all know that real estate has gone down to a downturn. None of the valuation is right as per RBI regulations. RBI doesn't move it to IFRS. I think if we just move to IFRS, or just say the moment there is an NPA, you write down the valuation of the loan to zero. Then whatever you recover in the ARC process is your money. I think that will really change the behavior and the incentive of public sector banks to then sell out things. We just need to write it down to zero on day 90.
Okay, last question.
Sugu and Ila, thank you very much for a great presentation. I have one question for Sugu and one for Ila. Sugu, the question is, could we have a more nuanced discussion on NPA? For example, could we break NPA due to bad business decisions, overtly optimistic economic scenario? Second, importantly, I think judicial activism, clamping down on businesses. And third is the malpractice. I think that would make the debate on NPA a little bit more realistic, and we can understand where does governance affect this. So maybe a future NPA paper might have to look at this. And Ila, I think the question on the banking sector, do we need to rethink banking? I mean, this separation, if I think of banking as a very simple model of a saver, and then there's an intermediary called a bank that converts savings into lending, maybe the incentives are distorted because savers are relying on some regulator to prevent their savings from going bad, and lenders are more interested in sort of lending, maybe taking excessive risk. So is it time to sort of rethink banking away from these models and move towards what John Cochrane has been suggesting, that we don't need this kind of a model, we need more equity-based banking structure where there are no savers, you're just holding an equity, so you monitor the banks, it's not left to a third party doing the monitoring.
So
Thank you.
perhaps let's both of you take turns and brief closing comments.
I think the idea that you're suggesting with this is absolutely well taken. There's some ongoing work that and I'll happy to talk about later on this. I think the previous question, let me sort of admit that none of these problems are univariate, problems. For instance, the judiciary. I think to say that the judicial system is actually slow because they, judges select just themselves is the cause for it, I think is simplistic. The clear fact is there are so many statistics out there, the numbers, just the pure quantity in terms of, so there are other issues. I think let's be a little bit more sort of careful on, and in that same spirit, I also want to point out that while it may have possibly appeared that that these are the only problems, no, I think there are others, several other problems. We are talking about a multivariate setup here, not a univariate. And more broadly to all the other sort of comments that I think, remind me what were the other questions if I need to respond. Okay, sure, yeah.
Yes, banking is a very risky business. And I think that's why, let me go back to the first thing that Shamika said, which is that it goes through these crisis ever so often over the years. Leverage is very high. It is very hard to regulate banks. It is very hard to understand who they're giving loans to. And, maybe it should not be there. But the point is, we have what we have and we can't do away with it at one stroke. Maybe other things will evolve. In fact, what you see in the last couple of years is the evolution of NBFCs, where they go and raise commercial money through commercial papers, and then they go on and lend. Particularly, equipment financing, retail financing is a lot of small business loans, working capital is happening through NBFCs. So maybe a new business is developing, and as they will, they'll get regulated.
That banks should only hold 8% or 9% equity capital. I would be, I think, charitably call it this basically. Then think about the frictions. You will start. In equity capital. I think that given particularly the too big to fail, the moral hazard, etc., lots of other costs to actually leverage, I think there's possibly a reason to have them, much less levered compared to what they are currently. And this is something which I completely agree with. There is a need for thinking about the leverage itself in banks. 8% seems to be too undercapitalized, and I think everybody seems to somehow agree, and we have a sort of a problem of herding here.
Okay, on that. Well, first of all, I don't think any topic should be anathema. And I think this discussion, if anything, has reopened that conversation around privatization of some of the public sector banks. I don't think any topic when it comes to public sector banks, particularly if you have the larger objective of having an efficient banking system for an emerging dynamic economy like India. So to that effect, thank you both of you for this wonderful conversation. We can continue to talk more over some tea and sandwiches. Thank you for your time. Thank you for coming.